Good morning, everyone. I wish you all a happy 2026, and in a few weeks' time, 𝐓𝐡𝐞 𝐎𝐍𝐬, a prosperous year of the horse. Today, I'm going to talk about our broader outlook and how that links into the advantages of our flagship investment strategy, Global Multi-Asset Diversified Income. First of all, the investment outlook. We see risks, opportunities, and critically as well, important implications for how to build your investment portfolio. The first thing to highlight is that inflation in the US and globally has come down a lot. We all acknowledge that. We started to see central banks cut rates, but just in the last few months, we've seen a bit of stubbornness creeping into inflation. So there's a question mark over whether inflation can continue to fall further, which will enable central banks to continue to ease policy, which is normally a nice tailwind for stock markets. The other observation we'd highlight in the US as well is there's just some tentative signs that the labor market is softening. We've seen job creation slow down, hiring activity stall a little bit. So whilst it's not signaling a recession at the moment, it's definitely something to watch, and it certainly clouds the growth outlook and the macroeconomic and the investment outlook as well. The other thing that has really impacted markets in the last year or so is uncertainty, in particular policy uncertainty. If you recall, we had a huge spike in uncertainty in April of last year in and around Liberation Day, the day where the Trump administration announced a program of significant tariff hikes on imports into the US economy. Now, the US administration spent much of the last 6 months of last year dialing down the rhetoric, striking trade agreements, and that enabled uncertainty to really drop a lot. But again, just in the last few weeks, we started to see uncertainty creep up again, whether it's geopolitical uncertainty, whether it's economic uncertainty as well. And as we all know as investors, we like certainty, we don't like uncertainty. So the implication of this really is that you should be looking for an investment strategy that gives you a degree of consistency, a degree of certainty, for example, with a distribution that's high, attractive, and consistent, with a portfolio that's diversified as well. As I mentioned earlier, most major central banks are cutting interest rates now, with the exception of the Bank of Japan, who is tentatively increasing interest rates. Now, as I mentioned earlier, this is quite helpful for stock markets and for financial assets in general. But one of the implications that we have to be aware of is that as a result of rate cuts, bond yields come down. So the amount of income that you can generate from very traditional income-generating assets starts to fall. So you have to be more creative in generating that mix of income to a level which is necessary for your own life circumstances and investment objectives. The previous speaker and other speakers today will talk about the AI investment boom. It is a profound investment cycle that we're seeing that will have huge implications for how we live, how we work, but also the kind of profitability that companies, not just in the technology sector, but elsewhere in the economy will benefit from. But when you think about an investment portfolio, one of the implications of a very, very large investment or CapEx cycle is how do you finance that? We are seeing hundreds of billions of dollars of commitments to build data centers, to buy semiconductor chips. A lot of these companies will have to issue new bonds. And as more and more bonds get issued, that starts to weigh on the price of existing bonds. So again, this has implications for some of your more traditional asset classes, whether it's US treasuries or investment-grade corporate bonds. And so you have to look elsewhere for your sources of return. We've come out of the last 10 years of what we call a monetary cycle, where central banks via QE and interest rate cuts have really stimulated the economies. One of our major themes at Manulife is that we are moving into a fiscal-dominated world now. Most governments around the world, whether it's US, China, even Europe, are showing expanding fiscal deficits to levels that haven't been seen before outside of recession. This huge fiscal stimulus, again, is a nice tailwind for the economy and for financial markets, but it also has some salutary implications as well. In particular, the extent to which a huge amount of new, longer-dated bonds come into the market and put pressure on prices. So again, this has implications for your fixed income investments, but it also has implications for your equity investments as well. Some of the sectors that benefit from fiscal expansionism are not necessarily the same sectors that benefited from the QE era as well. So we need equity portfolios that are genuinely diversified and not skewed to a particular factor or sector. And then the other observation I'd highlight as well is that risk premia, or the valuation that markets are currently trading at, which is sufficiently incentivizing to us as investors to take that risk, is very, very low. So what this chart shows you is the stock-bond ratio. It's the ratio between the global equities index and the global bond index. And what you see here is that it's at an extremely high level. And so our observation there is to make further gains in equity markets this year is not necessarily just putting it into an S&P, putting it into a global equities ETF. You've got to be selective. How do you get selective? You pick stocks. You pick stocks that you think are attractively valued with good return potential. So we think that 2026 will be about selectivity. So those are some observations about the outlook. Let's now transition into why the global multi-asset diversified income strategy has a number of advantages given that backdrop that I've just highlighted. So a brief description of the global multi-asset diversified income fund. It is a managed volatility strategy in the sense that its realized volatility is brought down by its portfolio construction approach to a level that is comfortably below its relevant peer group. It's called an income plus strategy. It offers an elevated, attractive, and consistent dividend distribution, currently around 8 to 9%. And that is predominantly supported by the organic income generation of the portfolio. And it's got a strong performance track record. This strategy has been running for over 5 years now, annualizing attractive returns, both in absolute as well as risk-adjusted terms as well. And it's an unconstrained portfolio. It invests across the global market space, both in terms of broad asset classes, regions, styles, and factors as well. And then finally, it has a relatively ingenious approach towards using options for additional income pickup, as well as volatility management, which we'll talk about a little bit later on. Now, some of the highlights of the GMADI strategy. It's got a combination of both traditional sources of income, but also non-traditional sources of income. As I mentioned earlier, you're going to need to look for other sources of income as bond yields come down and as interest rates come down. So this is a portfolio that has some very familiar exposures. It has investment grade, high yield, emerging market bonds, and global equities. But in addition to that, it also has some diversifying asset classes and exposures, such as preferred securities, REITs, equity-related securities, covered calls, and collateralized puts for that additional income collection. And in addition to that as well, the volatility management side. So it is a truly blended hybrid approach to generating those returns and income. One of the other features about this strategy is that it combines both top-down and bottom-up disciplines and return sources. So typical multi-asset funds are predominantly top-down. They make asset allocation calls, but they don't spend too much time picking stocks, picking bonds. And pure equity funds or pure bond funds are predominantly focused on picking the right stocks or bonds, but don't pay a great deal of attention to what's going on in the world in terms of that top-down view, how much risk to take, which countries, which regions, which asset classes. This strategy combines both of those disciplines. It combines bottom-up security selection as well as expertise in top-down asset allocation. And you see that in the investment team that runs this strategy. We have our most senior chief investment officers across all of our disciplines managing this strategy. So we have our high yield credit, our emerging market debt CIOs picking the bonds, and we have our asset allocation CIOs bringing their expertise in helping to navigate the market cycle as well. It's a diversified strategy. It's in the name, but I also mentioned earlier as well, in order to navigate the uncertainty that we see, you need that diversification. So if you look at the asset allocation diversification, it's roughly 50-50 between fixed income and equities. But within that, truly diversified. We've got high yield exposure, emerging market bond exposure. Within equities, we've got both cash equities and the covered calls and the collateralized puts as well. And the equities portfolio at the moment, it's quite strongly invested in North America, but it also has diversity from a global perspective as well. But critically, what you'll see on the next slide is that US equity exposure is not all in one place. Just quickly on the fixed income breakdown, this is an attractive yield profile fixed income portfolio, a yield to maturity of close to 6.5%. And if you look at the credit quality as well, it's in that sweet spot of sort of double B, which is really the crossover between investment grade and high yield. And we think that's the sweet spot right now because credit spreads are tightening, because generally speaking, the liquidity environment, the investment risk environment is quite supportive, and corporate fundamentals look quite strong. So there's quite a strong appetite for credit risk at the moment, and hence our portfolio is skewed a bit more towards that middle profile of credit risk. As I mentioned earlier, the equity portfolio, truly diversified from a sector perspective. So a lot of equity portfolios that have done well in the last 10 years put all of their chips in the information technology basket, the Mag 8 or 7. This portfolio is much more diversified than that. We've got about 22% in information technology, but also 16% in financials, 14% in healthcare. So what we're trying to do is blend styles. We want some growth exposure, but we also want stocks that are cheap, that have the potential to re-rate higher. And this portfolio really summarizes the reality that you have to have a portfolio that can perform well in all market environments. The other key attribute to the GMADI strategy is income. So as I mentioned earlier, it's had a very consistent dividend distribution profile since inception, between 8 to 9%. And critically as well, it's a sustainable dividend distribution. Over 80% of that distribution comes from the underlying organic income generation from the portfolio. So this strategy is not overly dependent on capital gains to pay that out. And that's why you've seen strong NAV appreciation on top of the distributions that it's made since inception. And if you look at where that income comes from, it comes from a blend of the bonds that we hold, the stocks that we hold via the dividends and the coupons, but it also comes from that option strategy as well. The ability to collect premium from the covered calls that you sell or underwrite, and the ability to not only collect premium from the collateralized puts, but also earn income from the collateral that you receive from the buyers of those puts as well. The other thing to highlight, people may question, well, what happens if interest rates fall and bond yields fall? Surely your dividend distribution would come under pressure. Well, actually, if you look at the inception period for the GMADI strategy, we've had very, very different interest rate environments. We've had a period where interest rates were close to zero in the US. We've had a period where interest rates went above 5% and then now come down to below 4%. And what you see here is that the dividend distribution has been dead consistent throughout that whole period as well. And that comes from the magic of the portfolio construction and the diversification that you see in the portfolio as well. Let's talk a little bit more about the options overlay. So there are two types of options that we use in the portfolio, covered calls and collateralized puts. What is a covered call? It's when you have an exposure to equities in your single stocks. But what you then do is you sell call options at the index level to collect premium, but also to dampen the volatility of your equity exposure. Now, what we do is we don't write calls on individual stocks because we believe in this security selection, the stock picking alpha that we can generate from our equities portfolio managers. So we write call options at the index level. And as I said earlier, that is a means to collect income, but it's also a means to dampen volatility during times of market turbulence. What are collateralized puts? This is when we underwrite put options. We sell put options to counterparties, and that gives us some additional upside exposure to equities, because what we're doing is we're selling put options to people that want to buy protection. So if equity markets go up, we collect the income from the premium that we collect, but we also get to earn income on the collateral that our counterparty has to give to us when they buy the put option. So they might give us money market instruments, US treasuries and cash, and we can earn income on that as well. So you can see here there are two different types of options. Volatility dampening, additional upside participation, but they both benefit from that additional income collection. And we're typically dynamically rolling these options overlays as well to make sure that we are constantly refreshing the strike prices and mapping onto the prevailing market environments as well. As I mentioned earlier, one of the benefits of option writing is volatility management. Now, some strategies, in fact, most strategies don't like volatility because you see market drawdowns and therefore NAV drawdowns of the funds. But this strategy in some ways actually benefits from volatility. How is that? Well, when volatility picks up, the premium on options that you write goes up as well because the implied volatility goes up. And so as a result of that, our income collection goes up when volatility rises in markets as well. And so what you see is that there is a natural inbuilt smoothing of our returns no matter what the market environment is in. Just a bit more of a demonstration of how these options overlays work when you have, for example, a situation where equity markets go down. So in the gray at the bottom, if you just had a portfolio with equities and bonds with no options overlay, clearly when equity markets go down, you've got no options premium to collect. So the underlying asset prices fall, you take all of that down. But when you've got an options overlay with covered calls, you're selling calls, and covered puts when you're selling puts as well, you're collecting that premium, which helps to offset the drawdown in the underlying asset performance. And in the case of the covered calls that you're writing, you're also getting the full premium collection. And in the case of the covered puts, of course, you can manage the size of them down so that the extra value you get from the covered calls offsets the loss of NAV you get from the covered puts. So what happens there is you only capture a partial share of the market drawdown when equity markets fall. So again, there is an inbuilt volatility dampening drawdown mitigation approach to the portfolio construction. Let's talk a little bit about the track record since inception. So as you see here, a very, very smooth NAV progression upwards. In the last 3 years, annualized, this is as of November, the annualized returns in US dollars has been close to 11%. And in Singapore dollar hedge terms, the annualized returns in the last 3 years, close to 8.5%. And critically as well, if you look at the volatility, the realized volatility, about 8% since inception. So again, this is a volatility managed, mid to high single-digit annualized return type vehicle. If you look at the track record since inception, yes, there was a drawdown in 2022, but I'd highlight the speed with which the strategy recouped fully that drawdown was quite rapid. So by the end of 2023, beginning of 2024, the drawdown had been mostly recouped. As I mentioned earlier, this is not just about a return generation and income distribution strategy. It is also about volatility management as well. Now, clearly, when you are making an investment, your risk appetite might dictate that you don't want to experience a great deal of volatility. So if you compare the GMADI strategy's realized volatility of NAV since inception over different time periods, it's comfortably below the Morningstar category that this fund sits in the average as well, meaningfully below. So what ends up happening is you have a Sharpe ratio, which is basically your volatility of returns over, realized volatility of returns is much, much higher than the wider peer group of available multi-asset opportunity funds as well. So this is a strategy which gives you a much more consistent, dependable, reliable experience during your holding period. So if I was to summarize the 5 or 6 key attributes to the Global Multi-Asset Diversified Income Fund, before I do that, just a quick recap of the investment outlook. We see that inflation has come down, but maybe prices are quite sticky. We think that as interest rates come down, the amount of income yield that you can get from your very traditional investments is a bit constrained, so you have to have a more diversified, original way of thinking to generate income. We think that top-down equity market valuations are somewhat extended now, so you really need a selective approach. So ideally, you want a strategy that combines the ability to go between asset classes, but also has the performance generation from your stock pickers, from your bond pickers as well. And in addition to that as well, uncertainty looks like it's on the rise again. So you want an investment strategy that has consistency of returns, can dampen volatility, and has that attractive dividend distribution payout, which gives you that anchor to your portfolio in terms of the returns that you're looking for. So to summarize, the Global Multi-Asset Diversified Income Strategy is a pure income solution in terms of the portfolio being constructed to be able to support an 8 to 9% dividend distribution, and 80% plus of that income distribution comes from the underlying income of the portfolio. So it's not that dependent on market direction. It's blended across multiple sources of income, not just asset classes, so there's high yield investment market, emerging market debt, equity dividends, but it's also getting it from the options overlay as well. And we have a derivative center of excellence at Manulife. It's unconstrained and well diversified. There are no restrictions in terms of the asset classes that we might go into, the countries or the sector limits. We can really go where we see opportunities. As I mentioned earlier, it's risk managed with modest volatility as a result of the options overlay, as a result of the asset allocation disciplines that we employ. And the option writing strategy is truly differentiated as well. We don't just write options on anything. We try to isolate the alpha from stock selection, from bond selection. We do it at the index level, and we can also alternate between call options and put options. And as I mentioned earlier as well, when volatility goes up, the options income that we collect goes up as well. So it's naturally benefiting from that volatility. And then the final point to highlight as well, this is a flagship strategy for Manulife. The team of portfolio managers that run this are our most senior, seasoned investors across the whole business. Credit experts, treasury experts, emerging market debt experts, equity experts, and also asset allocation experts as well. So just as a final message, as we move into 2026 and beyond, where we might encounter periods of volatility, where uncertainty goes up, where economic growth might be uneven and highly dispersed, you want a strategy that's truly diversified, generates its returns from multiple sources, and has a track record of consistency as well. And with that, I'll leave it there. Thank you very much for your time, and I hope you enjoy the rest of the event today. Thank you.